Ed, happy holidays. Great to have you back. I got to say, your call on crude in the middle of the year when everyone else was saying otherwise, still one of the best directional calls of the year, I think, at least in commodities. I wonder just your thoughts on how 2023 is going to shape up.
Well, actually, we think it's going to shape up significantly like 2022. We think there's going to be more oil in the market than demand. We have Chinese recovery not really happening yet. There are no lockdown measures, but people aren't going back to work because of the record amount of COVID. So any recovery is going to be toward the middle of the second quarter at the earliest. And we have a U.S. recession, or at least a sharper slowdown coming up before that. And as we look at demand right now, year on year, it's lower than it was a year ago. So we think supply is going to be more robust by a factor of 2, knowing that there are a lot of unknowns. But the 500,000 to 700,000 barrels a day of potentially lost Russian crude that you noted with Lavrov's statements are something that we've already factored into our balances on the one hand. But it's intriguing that Lavrov says that right after Novak, the deputy prime minister, not the foreign minister, but the deputy prime minister, said Russian production is going up this quarter versus last. So we'll see how noisy the Russian news is.
Right. What do you say to those who do argue that you will see supply seize up and see sharply higher prices sometime in the coming year? You must be assigning some kind of probability on that scenario.
Oh, absolutely. But we don't think it's a function of a lack of U.S. or Brazilian or Canadian supply. We think that the Western Hemisphere is going to be adding a good 1,400,000 or 500,000 barrels a day alone to where the markets are. We know there's dissent within OPEC, with the UAE wanting to pump more oil, not cut back more. So I think the big issue on the supply side really is whether there are going to be disruptions from supply from Libya, which is at 1.2, could go down to 200,000 or 300,000 a day. Iran, where we have people taking to the streets, just as they did in 1978 and 79. They have not yet gone to either the wellheads or to the refineries or to the ports. But that's not a low probability. And Iraq also is suffering from significant strains at home. We have the largest party having pulled out, not having been able to create a government after the elections of some 13 or 14 months ago. So there's plenty of oil around Russia, Iraq, Iran, Libya, Nigeria, which could fall out of the market. So we think the supply side risks are really on the disruption side, rather than some kind of faltering of U.S. production growth or sometimes some kind of spurt in demand growth.
On the flip side, Ed, and I know we have zero visibility into this, but what if the war ends in Ukraine? What would happen to the price of oil?
Well, I think if the war ended, we'd see the price suddenly going down. But I'm not sure that knee-jerk reaction would reflect reality. There are long-term lessons that have been learned in Europe about their overdependence on Russian material. This is Russian material that goes across some 30 different commodities, where Russia is the number 1, 2, or 3 supplier to the markets. They had been rather blasé about thinking that they were so interdependent with Russia that Russia would never take action, let alone military action, to upset the status quo. And I think that lesson, particularly given the humanitarian disaster that's unfolding in Ukraine, that lesson is in the European political system, including the important German political system, when it comes to increased reliance on Russian commodities. So I don't think we're going to see, with a sudden truce, that we're going to see anything sudden happening with respect to price caps, with respect to reluctance to buy Russian crude, until we see what the Europeans see, what the U.S. sees, what the G7 sees in terms of what the next steps might be.